Right now, I mean, tech giants are borrowing tens of billions of dollars to build AI infrastructure. Like the money is, just completely free.
Yeah, it's wild.
It is. While everyday consumers are out here suddenly treating, of all things, whey protein powder like it's a scarce luxury asset, it is a completely chaotic global market today, and we are connecting the dots.
We really are.
Hello and welcome. Thanks for keeping it locked right here on NovaStream, your 24/7 streaming channel. Whether you're running the live ticker on your second monitor or just listening in on your commute, we are diving straight into the ultimate highlights of the day across the live crypto markets, global financial indices, and the breaking news feed.
It is great to be here with you because, you know, what the raw data paints today is a picture of capital migrating in incredibly aggressive, almost contradictory directions.
Totally.
We're watching these massive undercurrents shift beneath the surface, and our focus is, well, basically decoding the mechanics of why these tickers are flashing red and green for you.
Right, so let's get right into the global financial indices because the macroeconomic weather system is shifting really fast. The U.S. wholesale inflation numbers just broke on the feed.
And they're hot.
Yeah, the producer price index, the PPI, it jumped 0.7% in February,
Wow.
which is, the biggest back-to-back increase we've seen since 2022. That puts the 12-month rate at 3.4%. And core wholesale prices, so stripping out the volatile stuff, that's up a sharp 0.5%.
Right, and just to give some context there, wholesale pricing is essentially the weather system forming out over the ocean.
Like a leading indicator.
Yeah, precisely. By the time it actually hits the grocery store shelves, the hurricane is already making landfall, so we know consumer pain is coming.
But here's the friction point that I'm looking at. If inflation is this sticky across the board globally, why is the European Central Bank, the ECB, aggressively hiking rates for the first time since 2023, while the U.S. Federal Reserve just kind of sits there completely still?
Well, it really comes down to a fundamental difference in their structural mandates and geographic vulnerability, too.
Okay, break that down for me. The mandates first.
Sure. So the Fed is legally bound by a dual mandate. They have to balance maximum employment with stable prices.
So they have two jobs.
Right. Two jobs. If the Fed hikes rates too hard to crush that 0.5% core inflation, they risk triggering a domestic recession.
And massive job losses.
Yeah, and they'd fail that employment mandate. But the ECB, they operate under a single primary mandate, which is just maintaining medium-term price stability.
Interesting.
So they don't have to weigh the employment side of the scale the same way the Fed does.
But I imagine it goes deeper than just the legal rule book, right? Because the ECB is looking at a completely different energy map than the U.S.
Oh, absolutely. Europe is a heavy energy importer, which makes them highly exposed to geopolitical supply shocks.
Like the Middle East?
Yeah, with the ongoing military posturing in the Middle East and the blockades keeping Iranian oil out of the broader market, energy prices are just a live wire right now.
So the ECB is terrified of those rising crude costs bleeding into core food and services across the Eurozone.
Precisely. So they are actively choosing to hike interest rates into a supply shock. It's sort of like slamming on the brakes while you're already skidding on ice.
That's a great way to put it.
They feel they have to act aggressively from a lower baseline just to build a firewall against imported inflation.
Which means the ECB is essentially playing defense against geography, while the Fed is playing a waiting game with domestic data.
Yeah, that's a good summary.
Now, tracking this cost of capital is fascinating to me because while high interest rates are designed to, suffocate borrowing and cool down the broader economy, there is one sector completely ignoring the macroeconomic reality right now.
Big tech.
Big tech. I'm looking at the breaking news feed right now. Amazon just secured a massive $17.5 billion credit facility.
And look at the terms on that.
Right. They are taking this on at the secured overnight financing rate, plus a margin of 0.625% to 0.875%.
That financing structure is the key detail for anyone watching the indices. Taking on floating rate debt in a high-rate environment is incredibly expensive.
Yeah, they are taking on variable interest rate risk at the absolute peak of the cycle. This brings Amazon's external financing to over $80 billion just this year alone.
Staggering.
All marching toward a stated target of $200 billion in AI capital expenditures by 2026.
Right.
Now, Amazon CEO Andy Jassy is defending the cash burn. He's comparing it to the early days of building out Amazon Web Services, AWS. But with the broader market tracking $700 billion in big tech AI outlays this year, we really have to ask, Is this the necessary foundation of the next digital era, or is it just an endless speculative money pit?
Well, the theory driving these tech giants is that you must lay the physical infrastructure today.
The data centers, the fiber.
Yeah, all the custom silicon. You build it today to capture the software margins tomorrow.
Yeah.
But the risk model here, it assumes frictionless, exponential corporate adoption.
Then that's not happening.
No, the problem is the corporate customers are starting to balk at the monthly bills. The traditional laws of supply and demand are finally, catching up to the AI arms race.
We are seeing that resistance play out in real time. There's this phenomenon called token maxing.
Yes, this is fascinating.
So for you listeners tracking the tech sector, tokens are basically the unit of measurement AI companies use to bill their clients. And right now, corporate employees are essentially engaging in performative AI use.
Right, just running massive scripts.
Yes, summarizing endless, unnecessary databases and just maxing out their software limits simply because the tools are there.
And is generating catastrophic bills for their employers.
Exactly. I mean, we're seeing major players like Microsoft actually canceling some Claude licenses. Amazon is actively removing internal AI leaderboards to discourage this wasteful behavior.
Yeah, Uber is openly questioning their return on investment.
And that corporate pushback is instantly compressing the margins for the AI developers. We are watching a really cutthroat price war brew ahead of these highly anticipated 2026 IPOs.
Yeah, OpenAI was valued at $852 billion in March, and Anthropic hit $965 billion in May.
Insane valuations.
Right, but to justify those trillion-dollar valuations to public investors, they cannot afford a mass exodus of corporate clients.
No, they can't.
The Silicon Data LLM Token Expenditure Index, it just plummeted from $2.05 in May down to $1.80.
Yeah.
So OpenAI is now actively exploring slashing their token fees just to stop the bleeding and keep users on their architecture.
So we are seeing this desperate scramble for AI dominance literally pull capital from every corner of the market. And this brings us over to the live crypto markets, because these massive trillion-dollar tech valuations, they don't exist in a vacuum.
And we don't.
When institutional capital decides it needs to fund a $700 billion AI infrastructure build-out, it creates a black hole for liquidity. That cash is being drained directly out of digital assets.
It's arguably the defining capital rotation of the year, when risk appetite shifts forcefully toward high-growth, mega-cap traditional equities. The market has to find the cash to buy in somewhere.
Right.
So they use liquid, non-yielding assets as their ATM.
And right now, Bitcoin is that ATM. Looking at our live charts on NovaStream, Bitcoin ETFs have shed $2.1 billion so far in June.
Which is massive.
Yeah, that drops total net assets down to roughly $77 billion as Bitcoin hovers around $62,560. But the catalyst here isn't a failure of the crypto protocol, it is the upcoming mega listings.
Yeah.
Take the SpaceX IPO scheduled for June 12th. We are talking about a $1.75 trillion valuation targeting a $75 billion raise.
The mechanics of an IPO that size are highly disruptive to the broader markets. Analysts refer to this as an exit liquidity rotation.
Okay, explain that for us.
So, to participate in the SpaceX listing and secure those shares, institutional players and retail traders alike have to free up immediate capital.
They need cash on hand.
Right. So they liquidate their digital asset positions, which drains the order books on the crypto exchanges. The market becomes much thinner.
Making Bitcoin highly susceptible to severe downward price swings.
Yes. The sheer gravity of Wall Street's tech appetite basically overpowers the steady capital flows that were previously supporting the crypto ETFs.
There is a massive irony embedded in that rotation, though, considering SpaceX's own SEC filings reveal they hold 18,712 Bitcoin on their corporate balance sheet.
That is ironic, yeah.
The moment they go public, they instantly become one of the largest publicly traded entities holding digital assets, yet their own IPO is starving the crypto market of liquidity.
It's a paradox for sure.
Now, whenever we discuss this digital liquidity drain, the prevailing counter-narrative is always that traditional finance is stepping in to adopt crypto and fill the gap.
Right, the institutional adoption narrative.
Yeah, and we're seeing a flood of headlines today on the feed about major banks like Deutsche Bank and JP Morgan partnering with Ripple. But let's look at the actual plumbing here. Are these Tier 1 banks actually holding XRP on their balance sheets?
The short answer is no. And the distinction between software adoption and asset accumulation is really critical here.
Okay.
The partnerships with Ripple are very real. Deutsche Bank, for example, they're integrating Ripple's software stack for cross-border payments and digital asset custody.
Right.
But the actual settlement layer for these institutional partnerships, primarily utilizes RLUSD, which is Ripple's dollar-pegged stablecoin.
So they are using the rails, but they're not taking a directional bet on the asset itself.
Exactly. Even with Ripple's on-demand liquidity product, the software might consume XRP to bridge two fiat currencies, but it buys and sells the token in seconds.
Just a flash transaction.
Yeah, that creates transaction volume, sure, but it does not create a long-term hold on a bank's balance sheet.
Okay, but what about the situation in Japan? Because SBI Shinsei Bank is running a pilot program right now offering crypto vouchers to 4.33 million depositor accounts. They are handing out Bitcoin, Ethereum, and XRP.
That is true, yeah. They are offering vouchers worth 20% of a customer's interest payments.
Wait, but let's run the math on that for a second. Japanese interest rates are practically sitting at zero.
It's very close to it, yeah.
If a depositor has, say, $6,200 in their account, they are earning maybe $10 worth of vouchers over an entire year. Doesn't that prove this is just a very clever customer acquisition gimmick rather than meaningful institutional adoption?
Yo.
I mean, it's a distribution play, not a signal that a Wall Street bank is buying billions in XRP for their corporate reserves.
You are absolutely hitting on the core reality of that program. It is a fantastic mechanism for getting digital assets into the hands of retail users, and SBI Group has always been a strategic ally to Ripple.
Right.
But you are correct. Substituting microscopic interest yields with crypto vouchers is fundamentally different from a sovereign wealth fund or a major financial institution replacing their treasury bills with XRP.
The structural demand just isn't there yet.
No, it's not.
So we have digital tokens facing these mechanical liquidity drains, but if we rotate our focus away from the digital sphere and look at physical commodities on our indices, we are seeing supply chains buckling under the weight of changing consumer behavior.
Oh, big time.
I want to highlight one of the most bizarre economic indicators on our board today, which is whey protein.
The dairy derivatives market is flashing warning signs that basically nobody modeled for at the start of the year.
It is acting like a Veblen good. Driven by the broader wellness craze and the absolute explosion of GLP-1 weight loss drugs, consumer diets have fundamentally shifted.
Yeah, people are eating less junk.
Right, and they're desperately trying to pack more protein into smaller meals to preserve muscle mass. As a result, WPC 80, which is whey protein concentrate at 80% purity, it is skyrocketing to $12 to $13 a pound.
That's incredible.
Whey protein isolate is hitting $14 a pound. These are historic highs for something that is literally a byproduct of the cheese-making process.
But the mechanism driving this shortage is biological limitation.
Yeah.
You cannot just spin up a new server farm to generate more whey. It requires dairy cows, grazing land, and physical processing facilities.
It takes time.
Yeah. When a pharmaceutical trend like weight loss drugs suddenly alters the dietary habits of millions of people, the physical supply chain just cannot scale fast enough to meet it.
So food manufacturers are scrambling to inject protein into everything from, potato chips to iced coffee foam. And the system is just physically tapped out.
And the financial damage to the consumer brands caught in the middle is severe. Companies are completely selling out of their supplies.
If you look at Bellring Brands on the ticker, they're the parent company behind Premier protein drinks and Dymatize powders. They're getting crushed by these raw input costs.
Just hammered.
Their stock is down 68% this year. They are trapped paying astronomical wholesale prices for dairy, which they eventually have to pass on to the consumer at the grocery store.
Which loops us right back to the sticky inflation data we opened the broadcast with.
It really does. It's a perfect closed-loop example of how consumer trends translate into supply shocks, which then manifest as corporate margin compression. We are seeing this same desperate scramble to adapt to changing environments in the retail sector, too. Look at how GameStop is completely pivoting away from being a digital casualty.
They've had a wild year.
They just delivered a blowout Q1 FY26 earnings report, and the underlying mechanics show they are no longer just a struggling brick-and-mortar video game store. They have basically transformed into a cash-rich holding company.
The market is currently struggling to accurately price that transformation, though, because the revenue mix is so heavily altered.
Let's break down the actual numbers for the listeners. Earnings per share came in at $0.30 against a $0.04 estimate.
A huge beat.
Operating income swung from a massive loss to a $143.3 million profit in a single year. But the fascinating part is how they did it. Collectibles, trading cards, high-margin merchandise surged 65% and now make up nearly 42% of their total sales.
Oh,
And on top of that, they authorized a fresh $2 billion stock buyback fueled by the massive $83.7 million in quarterly interest income they are generating just from sitting on a mountain of cash.
right. And the bull case focuses entirely on that interest income and the aggressive capital deployment.
Yeah.
But if we analyze them as a holding company rather than a retailer, we have to stress test the liabilities.
Okay, what's the bear case?
The bear case centers on their debt structure. GameStop is carrying roughly $4.16 billion in convertible notes.
And for anyone who doesn't track corporate debt structures every day, a convertible note is essentially a ticking clock.
Yeah?
It's a loan that the lender can convert into equity. So, shares of the company if the stock price is high enough. But if the stock price drops below that conversion threshold, it does not convert. It just remains a massive multi-billion-dollar debt anchor that the company eventually has to pay back in cash.
Precisely. It is highly dilutive if the stock rallies and highly burdensome if the stock falls.
Yeah.
Add to that the fact that GameStop holds a $519.4 million position in Bitcoin.
Which we just talked about.
Right. And as we just discussed, Bitcoin is currently facing severe liquidity headwinds from the tech IPO rotation. So you have a retail brand attempting to operate like a sovereign wealth fund, heavily exposed to both crypto volatility and complex debt instruments, all while basically selling Pokemon cards to generate free cash flow.
It is the perfect snapshot of the bizarre financial architecture of this market right now. But we really need to bring all of these threads back to the breaking news feed.
Yeah.
Because everything we have mapped out today, the European Central Bank hiking rates in fear of an energy crisis, the fragile physical supply chains, the cost of shipping goods, it is all ultimately tethered to global geopolitical stability.
It is. And it's important to note here for you, our listeners, that we aren't looking at this next story through a left-wing or right-wing political lens.
No, absolutely not. We need to state right up front, NovaStream's mandate is strictly to track the raw geopolitical facts.
Yeah, just the military posturing and how those maneuvers instantly reprice risk in the energy markets and global shipping lanes.
Yeah.
We don't endorse any specific political viewpoints.
Right. So with that objective lens in place, the breaking story today is U.S. Defense Secretary Pete Hegseth's visit to the U.S. Navy base at Guantanamo Bay, Cuba.
Right.
This visit is unfolding right as the Trump administration is applying heavy pressure for political and economic overhauls within the Cuban government.
Yeah.
The Pentagon framed the trip as a standard morale visit. Hegseth worked out with Marines and ran the perimeter of the base, calling it a highly strategic piece of American terrain.
But the rhetoric deployed during the visit acts as a direct signal to the global markets. Hegseth issued a blunt warning to Cuba against obtaining weapons capable of striking the U.S. mainland or the naval base.
Right.
Furthermore, while in transit, he amplified remarks from President Trump praising the ongoing U.S. blockade against Iran, framing it as the most successful in the history of naval warfare.
When you combine active military warnings in the Caribbean with aggressive ongoing blockades against a major oil producer like Iran, you see exactly why the global supply chains remain incredibly fragile.
It's all connected.
It circles back to our first point. This is the exact geopolitical heat that keeps the ECB awake at night, forcing them to hike interest rates to protect their currency against a sudden spike in crude oil.
The interconnectedness of these events is what drives the volatility. You cannot separate the military posturing in the Gulf from the cost of debt in Europe or from the inflation metrics hitting the U.S. consumer.
So let's tie it all together for you. We have sticky global inflation forcing a wedge between central banks. The ECB is playing defense against energy shocks while the Fed holds steady.
Right.
We are watching a $700 billion capital vacuum created by the AI arms race, heavily financed by floating rate debt, which is currently draining liquidity out of the crypto markets to fund mega IPOs like SpaceX.
Yeah.
We are navigating bizarre physical bottlenecks where weight loss drugs turn whey protein into a luxury commodity. And underlying the entire board is a layer of geopolitical tension that threatens to disrupt the energy supplies powering it all.
The ultimate takeaway for you today, whether you are adjusting your 401k, trading digital assets, or just trying to understand the cost of your groceries, is that tracking the rotation of capital is the only way to navigate this volatility.
Spot on.
Capital is fleeing non-yielding digital assets to fund high-growth tech infrastructure. It is pivoting out of traditional retail and into wellness commodities. Recognizing where the money is flowing, and more importantly, where it is fleeing from, is your strategic advantage.
I want to leave you with one final thought to mull over as you watch these tickers today. We have spent this broadcast looking at two very different types of constraints. On one side, we have the digital realm, where tech giants are consuming seemingly infinite amounts of debt and electricity to build AI data centers.
Endless ambition, right?
Right. But on the other side, we have the physical realm, where commodities like dairy protein are facing hard, historic shortages simply because of biological and land constraints. So, what happens to the global markets when the boundless trillion-dollar ambition of the digital tech sector finally, inevitably, collides with the hard physical limits of our planet's resources?
That is the defining economic question of the next decade, and it's the exact friction point we will be monitoring closely.
And that wraps up our highlights of the day. We are navigating a highly complex financial landscape, but by mapping out the mechanics behind the macro data, the tech outlays, and the physical supply chains, you are now ahead of the curve. Thank you so much for joining us. Keep it locked right here to NovaStream for your 24/7 market coverage, and we will catch you on the next update. Goodbye.